The silver market isn't collapsing with explosions, it's leaking quietly. And leaks are more dangerous because most people ignore them. A single internal banking document has allegedly exposed a numerical imbalance that should never exist in a functioning market. This document claims that physical silver holdings are overwhelmed by paper promises written far beyond deliverable reality. According to the leak, thousands of paper claims exist for every ounce of real silver sitting inside global vaults. That ratio is not aggressive leverage, it's structural impossibility masked by confidence and delayed settlement. Markets can survive volatility, but they cannot survive arithmetic that no longer balances. Silver is not a digital asset. It cannot be copied, printed, or synthetically manufactured when shortages appear. Every ounce must be mined, refined, transported, and stored in the physical world. Paper markets expanded because delivery was rare, not because supply was abundant. That assumption is now breaking as physical withdrawals accelerate behind the scenes. Institutions are not waiting for headlines. They are securing supply while prices still reflect paper logic. Industrial buyers don't trade sentiment. They secure inputs required to keep operations running. Solar panels, electronics, medical equipment, and defense systems all depend on consistent silver access. When industrial demand rises, investment supply quietly disappears from circulation. The alleged document suggests a silver-related liability approaching $15 trillion globally. No financial institution can absorb that scale of mismatch without cascading consequences. This is where confidence becomes fragile instead of stabilizing. Markets do not collapse when people panic, they collapse when systems fail to perform. If even a small percentage of paper holders demand delivery, the structure fails immediately. Cash settlement becomes mandatory when metal is unavailable. Cash settlement destroys the core reason investors hold silver exposure. At that moment, paper silver stops behaving like silver entirely. History shows trust collapses faster than it is built. Bank runs begin with realization, not hysteria. The realization here is that claims vastly exceed physical reality. As vault inventories shrink, leverage embedded in paper contracts expands dangerously. This divergence cannot correct itself smoothly. Price suppression only works while physical supply remains available. Once supply tightens, price becomes the only release valve. A higher silver price would not represent speculation, but forced equilibrium. Hundreds of dollars per ounce sounds extreme until scarcity is properly priced. Price reflects availability, not comfort. Paper silver thrives during complacency, not during shortages. The more physical metal leaves vaults, the weaker paper confidence becomes. Large players move quietly because panic ruins positioning. Retail investors usually hear the story after positioning is complete. By the time confirmation arrives, exits are limited or closed. Denial feels safe until it becomes expensive. Silver isn't rising because of hype. It's rising because supply is tightening. Every industrial contract removes silver permanently from circulation. Unlike gold, silver is consumed and rarely recovered. That consumption makes long-term shortages unavoidable. Paper markets ignore this reality until forced to confront it. When that moment arrives, repricing is sudden, not gradual. Markets never ask permission before resetting broken systems. The alleged HSBC leak accelerates awareness of an already fragile structure. Even partial accuracy carries serious implications. Confidence-based systems fail rapidly once doubt spreads. One failed delivery can trigger cascading defaults across exchanges. Comex, LBMA, and ETFs rely on similar delivery assumptions. If delivery becomes unavoidable, paper structures unravel. Ownership matters more than exposure during systemic resets. Exposure settles in cash. Ownership survives disruption. This distinction separates winners from casualties. Silver's role as monetary metal resurfaces when trust erodes. History repeats this cycle without exception. Whenever claims exceeded reality, reality eventually prevailed. Timing is unpredictable. Outcomes are not. The longer imbalance persists, the more violent correction becomes. Markets forgive delay, but never forgive denial. Silver doesn't need universal belief, only marginal demand shifts. Once tipping points are crossed, repricing accelerates itself. Liquidity disappears precisely when it is needed most. This is why exits close faster than expected. Paper assets fail quietly, then suddenly. Holders realize they owned promises, not metal. That realization defines loss. Silver's reset would be mechanical, not emotional. Numbers, not narratives, drive systemic collapse. What looks stable today is often brittle underneath. Paper confidence masks physical absence. When absence becomes visible, pricing explodes upward. Silver cannot be printed to solve shortages. No policy can manufacture atoms. Reality always overrides financial engineering. This is not a trade, it is a fault line. When it moves, everything above it snaps. Ignoring structural imbalance is the most expensive position. Preparation is quieter than panic. Those who act early never need headlines. Those who wait learn through loss. This moment rewards understanding, not optimism. The market doesn't care what feels fair. It only responds to supply, demand, and truth. Disclaimer. This content is for educational and informational purposes only and does not constitute financial advice. Markets involve risk. Verify all claims independently and consult qualified professionals before making any investment decisions.